Yeah, let's get started.
Okay. Hi, everybody. I'm Bonnie Halper. I write the weekly Startup One Stop newsletter. And you can register at startuponestop.com. And ordinarily, we host these twice a month, every other Thursday at Kettle Space. We want to thank Kettle Space for hosting us. Oh, and I also work with startups. I help them with their decks and talking points. And none of you guys know how to talk to investors, right, Geri? None of them. And I want you to talk about that too, because I'm dealing with a startup and they just don't understand that. But anyway, I want to thank Kettle Space for hosting us. Now they're hosting us virtually. Mac, you want to talk about Kettle Space, which is very affordable restaurant co-working?
Sure. Yeah. Thanks, Bonnie. My name's Mac. I'm the event coordinator for Kettle Space. So Kettle Space is a co-working space in New York City that partners with restaurants and other hospitality focused spaces in their off hours to provide spots to work out of. In days of COVID past, we hosted Bonnie's breakfasts at some of our locations. So recently we launched a digital platform to help our members connect professionally. So there's like a job board, you can kind of trade services, and a huge list of discounts on products and services like Zoom and the Adobe suite, things like that. And we also help our members like connect socially. So there's a community message board on Slack. There's virtual happy hours, coffee meetups, and it's been going really well. A big part of the platform is hosting events like these designed to inform and support our members. So it runs the gamut of these breakfast with an investor and morning meditations. Best part is it's free to use. I'll be sending a follow-up email to all of you if you're interested in joining with links and just a recap actually of what we talked about here today. So that's my spiel. I'll kick it back to you, Bonnie.
So, Geri, you want people to go around and introduce themselves first?
Yeah, that would be great if we could just hear a little bit about, just everyone's name, company you're working on, or just whatever reason you have for kind of tuning in today. That would be great for me just to kind of tailor the discussion that way.
And Fran is a fellow investor, by the way. She's an angel.
That's not what everybody calls me, though.
So, Terrence, you're take it away.
Hi, I'm Terrence Finn, and I'm a product and technology leader. I actually just left a company I was running called VeloTooler in January. So I'm looking for my next opportunity. But my background is in software. I'm a 2-time CTO, and I've also led product in the healthcare space.
Great.
I guess I can go next. I'm Sam Bogoch, and there's actually 2 of me up here. I'm using my computer for audio and my phone for video, so go figure. Anyway, but I'm actually one person.
But he wears many hats.
I do wear many, yes, as any entrepreneur. I run a company called Axle AI. We did about 850,000 in revenue last year, and we are a bootstrapped video tech company. We basically help media teams search and collaborate through their browsers. So actually we're seeing a nice surge in business right now as people adapt to COVID-19, but we basically let them work with high-res media over the network. And then we do things like AI analysis of the content for them.
Cool.
Clarence, you want to go next? Oh, I think we can't hear you.
Hello?
We can't hear you. Okay. Galena, take it. You want to introduce yourself, Galena? Are you out on the West Coast?
Hello, everyone. No, it's just like wallpaper here.
Oh, okay.
I work in accelerator in Eastern Europe, in Ukraine, Sector X. And last year we brought our startups to New York, and Kettle Space were so kind to host us for one of our events. So that's the reason actually why I'm here today. Just want to maybe hear some updates, interesting experience, how people deal with all this mess during the pandemic, because we have quite kind of the same here, and it's really tough times now. So thanks for this opportunity.
Sure, we're gonna start doing more of them too. But Geri kindly offered to be our first one. So if we could, so Vitaly, you want to introduce yourself?
Yeah, sure. Hi everyone. So I'm a member of Sector X that Galina meant. So I'm founder of Nexpo. Nexpo has built an API that makes shipping easy and affordable for small businesses, provide access to both domestic and international carriers, and allow businesses to print labels and compare shipping claims. And thanks for having me. So, and hope that everyone will share tips for this uncertain period. So,
Go ahead. You want to go, Fran?
Sure. I'm Fran. Well, obviously, there I am. I do angel investing, as Bonnie had said. I also do professional coaching for career inflection points that people have. And I do executive search for startups and large legacy companies. And have for the last many years.
Rachel, I know that you have your audio muted, but you want to introduce yourself? Oh, there we go.
Sure. Yeah, just in case there's background noise, I'm like, I'll just keep it muted until I have to talk. Yeah, my name is Rachel. I'm a community manager at a company called Entra, which is like a social network for entrepreneurs. But, you know, as a side project, I've been kind of trying to solve a problem with people that work remotely and the isolation that they feel. So my goal was to connect people that work remotely in person so they can socialize. Obviously, this is like before COVID-19, so it's not really possible right now. But I also, you know, still want to learn and like keep working on it kind of on the side. So that's why I joined today.
Oh, well, welcome. Elena? Oh, she's muted as well and shy. All right, Zach, take it away.
Zach, I think your audio is not connected.
Yeah.
Oh, or you're muted.
Yep.
You seem like you're on two devices and one is muted.
Right. Oh, yeah, this one. That's the phone is muted. Up. Sean, do you want to introduce yourself while Zach is sorting that out? Where did Sean go? Oh, he's muted too.
Hey,
Everybody's muted.
Hampton. Can you hear me now?
Yes.
Yeah.
Okay. Sorry. I was having technical difficulties. Technology is great till it doesn't work.
Right.
So I'm with Vauban Consulting here in Jersey City, New York City area. Happy to join the group. My contribution is previous CEO of several companies, sold them, helped scale several companies. So now what I do is I help startups with their go-to-market strategy, with their ability to pitch investors, whether it's seed, Series A, venture funds, and to get them ready to go out and scale the companies. So working a lot with some folks through Kettlespace. Happy to join, happy to contribute as you see fit.
Great.
John, do you want to introduce yourself?
Me? I didn't hear the name.
Where is he? Oh, I know he's there, but everybody seems to be muted. Who did we miss?
Geraldine, why don't you go ahead?
Okay.
Hi, I'm Geraldine. I am a Broadway pianist and conductor, and I have a business that is related to this, which is connecting theater music directors. I've had a group for those people for 10 years, which is at 8,500 members, and I organize classes where I connect them with Broadway conductors. So they learn from everywhere in the world, Australia, China, the UK, and the US on all coasts and in between. And they learn directly from Broadway conductors on very specific topic points. And this business has quadrupled with this crisis. And I'm looking to expand widely to actors because there's such a market there. And that's a much bigger endeavor and I need help with it, which is why I'm here.
Oh, you know, it's amazing. Some companies are doing really, really well. You know, I forgot to tell you how we do this, which is either our participants, our attendees introduce themselves, and then the investor, Geri in this case, talks about herself and her background in the fund and what they look for, and then we open it up to Q&A. So it's your platform. So I know that Sean is there, but he's muted. And Andrew, if you want to unmute and introduce yourself, or anybody else who we missed.
Sure. I'm Andrew. I'm not showing video because my hair really is unacceptable. So,
but we don't know what you looked like before. So
my wife's actually ordered hair cutting scissors from Amazon and is going to have a go at it when they arrive. But hopefully that won't arrive for a while.
So you'll really keep video off after that.
Yeah. Actually, that's probably right. So I'm a co-founder of a company, Catalex, and we're in the legal tech space. So we have a solution that can basically analyze contracts. We're just at the stage of sort of talking to beta clients. We've been bootstrapping to date, but we are interested in talking to investors soon. So, and this is the first sort of event like this that I've attended. So I'm interested to hear things from the investor perspective.
Andrew, where are you based?
I'm based in Westchester.
Okay.
Not far from the city.
Because you do have that accent. We do have an international crowd here.
Yeah, I'm originally Australian.
I knew that. So who else did we miss who wants to come off mute?
Shan here.
Okay, hey Shan.
Hey, how are you?
Okay, I see you're tired this morning.
Yeah, I'm walking and talking at the same time, so I figured it out. I was on mute on the app, and I was trying to unmute on the phone while I'm dialed in. So that was my issue. So my name is Sooran. I'm the founder of a company called Edwards Box. We have a platform for making the RFP process simpler, fairer, and faster. Our ultimate objective is to automate the RFP cycle, and we have built what we think of as a Bloomberg machine to slice through some of the frictions that buyers and suppliers encounter, in which we will gather the data we need to train the deep learning models for the automation.
Anyone else? Geri, you have the floor.
Great. Well, it's great to be here to meet you all and to see some familiar faces and names. Bonnie, is it helpful to just start with background or fund focus? What do you want to hear about first?
Well, let's hear about your background first.
My background. Okay. Well, we can start at the very beginning. I was born in Bulgaria, so also Eastern European roots here. My parents dragged me to New York when I was 2 years old. Pretty much been here ever since. You know, grew up in the Bronx, went to school in the city, and then went to NYU for college. And part of, you know, the story is initially my study abroad experience at NYU, because that's when I actually started working in venture for the first time. So I started my career with an internship at a fund called Credo Ventures in Prague. It's a seed and Series A focused fund. They're on their third fund now. And that was sort of my first dive into venture and entrepreneurship. And you know, it was interesting because I had initially wanted to go to business school for undergrad because I wanted to learn how to run a business. That was my area of focus. Once I got to business school, I found out that everyone there just wanted to work at Goldman Sachs. And it turned into, as many of you know, that unfortunately I did not know, as a big funnel into banking and consulting, much to my dismay. So it was great to find, you know, this initial venture internship, because I finally felt like I kind of found my footing in an entrepreneurial ecosystem, which is what I was really interested in to begin with. So, you know, through that role, I really, you know, I spent a lot of time meeting with founders who were very engineering focused at the time. It's probably still the same in that, you know, ecosystem right now, but a lot of engineers who had built things and had never really thought about monetization or business models. So it was a very interesting way to sort of get involved and, you know, work with founders on figuring out what's really the pain point. Okay, how can you actually articulate what you're doing in less than 2 minutes? And it's too complicated to explain is not a good answer. So it was a lot of, you know, hands-on work with founders in that regard. And, you know, through a combination of sort of genuine curiosity and naivete, I figured, well, if I did this at this one internship, why can't I stay in venture and keep doing this? So it didn't quite dawn on me how competitive venture had gotten. And so I kind of went for it anyway. And it's a good thing I did, because through some, you know, combination of fortunate circumstances, it happened to work out in my case. So from there, I ended up going to a seed fund in Sofia in Bulgaria, which is where I was planning on spending a couple months anyway. And it was a, you know, very similar environment, faster deal pace, again, sort of brand new fund at the time called Launch Hub. That was a generalist fund focused on seed investing. So it was, you know, another great experience of just being on the investment team with the 5 partners there, basically working on deals end to end. And then when I came back to New York, I basically started rebuilding my network here and figuring out, all right, how can I stay involved in venture once I'm back here and even after I graduate. And I ended up meeting at an event, one of the founding partners of Laconia, which is the firm where I currently am. So I worked with them on a part-time basis during my last year in school. Again, first-time fund. Clearly, all the first-time funds were happy to meet me. After a couple months there, they weren't ready to hire anyone full-time yet because of just fund constraints. So I worked for a couple of months at one of the Techstars accelerator programs in New York. It was an Internet of Things focused program run by Jenny Fielding, who now runs the New York City program. And so that was, you know, it was a combination of program operations, logistics, and portfolio support. So working with the companies on pretty much whatever they needed an extra set of hands on the business side. So for some of them, it was business development. For others, it was sort of related to their fundraising and pitching. But that was a great experience to kind of be shoulder to shoulder with 10 different companies for a couple months straight. I feel like that role was unique in the level of depth and perspective it provided into founders day to day in a way that you don't really get as an employee or as an investor. So I really value, you know, the perspective that I got through those couple of months there. And then circumstances led to me going back to Laconia full time as the fund was growing and they had the capacity to bring me on full time. So that was about 3.5 years ago. I've been there full time ever since. You know, we're investing out of our second fund now. Our focus is all B2B software companies, typically headquartered in Northeast major markets, no matter how arbitrary that constraint seems currently. And we typically tend to lead or co-lead seed rounds of 2 to 3 million. So our sweet spot is leading with a check of 500K to $1 million, working closely with the founders on syndicating the round, finding the other co-investors, making sure there's a strong board and investor group around the table to support the companies. And then we'll also reserve capital to invest in the Series A as well. And in working with founders, our main focus areas are sales acceleration, operations, and capital strategy. So by design, we take a very concentrated approach, especially relative to other seed funds. So we only have currently 7 to 12 companies per fund. That will probably increase a bit with our third fund to 15 to 20, but not beyond that. And you know, the benefit of that is that we have a lot of bandwidth per partner to work with companies. And even during our diligence process, a big component of that, in addition to all of the sort of standard VC diligence stuff, which we can talk about in more detail, we tend to make a number of business development introductions for founders so that we get some real market feedback on the value proposition, the differentiation, the founders, you know, identification of their target customer, and so that the founders get some sales leads out of the process, because we know how critical that is for companies at the early stages. And then a lot of our other planning is around, you know, really working with founders on making sure they're raising the right amount of money at the right time based on their operating plan and the constraints that they're facing, so that they're positioning themselves in a position of strength long term, so that at the end of the day, this has been worth their while, and it ends up being an exciting and lucrative event, not just for the investors potentially, but also for the founders and their employees. So that's a little bit about my background and what we do in a nutshell. Happy to talk in more detail about our diligence process, kind of what we're seeing on the market right now, given the current economic and health conditions. But happy to take it wherever you all think is most helpful.
I want to add two things that Geri didn't say. One, she was fairly recently made partner over at Laconia. And two, she's a force of nature. She really is.
Thanks, Bonnie.
It's true. So anybody have any questions or?
Hey, Geri, this is Hampton. One of the things that I see when I'm talking to company founders and people like yourself is because of the current business climate, the valuations have been thrown out the door, and now they're having to start over no matter what the cap table was before. Talk a little bit about how you look at it from a fund and saying, okay, here's a brand new business climate. We have to adjust the valuation, and how are you going about that with the various companies?
Yeah, it's a great question. It's something that gets talked about a lot right now. I think at the very early stages where we're investing, the impact is not as severe, perhaps. Now, I say that with a bit of an East Coast perspective, in the sense that we were never doing seed rounds or pre-seed rounds at $20 million pre-money valuations, which is a thing that I hear about, that I hear happens, but we've personally never really done any of those deals. So I don't feel like there's been a pullback from that. So I suppose if you were in the world where you were raising at those sorts of terms, right? So let's say above 15 million for a pre-product or a pre-launch company, I think those are definitely going to get scaled back. But the world that we tend to operate in at the early stages, seed, pre-series A, we're typically looking at, depending on exactly where the company is in its development and what the cap table looks like, anywhere from 5 to 10 million pre-money. Which is a big range, but again, it depends if you've just launched your product or you've been in market for 2 years and have a roster of customers. 5 to 10 million pre-money, typically raising $2 to $3 million. That's sort of what we were doing before, and I think that's what we'll continue to see. I think the place where founders are likely to take more dilution at that stage is actually in potentially taking on more capital than they would otherwise like to. So we've seen that with a couple of the deals that we're working on, including one that we just wired money for yesterday, which was exciting. They ended up raising a $5 million round instead of $3 million, but that didn't really warrant an increase in valuation from what was negotiated for the $3 million, if that makes sense. You're taking on that additional dilution, but the idea is that there's more instability in sort of your customer base moving forward. Potentially, you're not 100% sure what your sales cycles are going to look like 3 months from now, and you're not sure exactly what the capital markets are going to look like when you need to go out and raise additional capital. So that additional buffer is the piece that I think is more dilutive, and I just think, given all of the uncertainty, that additional sort of insurance policy is potentially what's going to have the most impact on companies. Of course, that's keeping in mind, that you're in a position of luxury where you even have that option, which I totally understand is not the case for all founders.
Sure.
I think the other thing that's going to happen realistically is less so that valuations across the board will come down, but that fewer deals will get done. So the outcomes will actually be more binary across the board. If investors can get to conviction that now is the right time to invest in a specific company in a specific sector, maybe the valuation gets a bit of a haircut, but not that much. Whereas, the thing I worry about more is that there's going to be a whole bunch of businesses that are just not going to be able to get funded in this climate, no matter what valuation you put on them.
Yeah, I think another trend, Geri, that I want to get your feedback on, sorry, Bonnie, I didn't mean to hog the questions, was this is what I've seen recently from another client that I was making introductions for. is the change in mentality for venture funds like yours to say, we want to see a plan for a company to get to break even in 18 months, not try to ride the rails of a valuation that gets to a crazy number that gets acquired, but they continue to lose money for 3 or 4 years. So I've seen that as a profound difference even before this started, that companies were looking at, show me the plan on how you're going to get to break even in 18 months. You know, feel free to comment on that too.
Yeah, so from our perspective, we've always talked about break-even optionality with any founders that we've been meeting with. So if for whatever reason you can't raise money 18 months from now, what are your levers to pull back and get to sort of that nominal break-even mode so you can keep surviving? So it's something that's always been on our radar, even as seed investors. And I do agree that now it's going to be more and more prominent. You know, as I'm sure many of you have been doing for your own businesses, we spent the bulk of March kind of going through all of our portfolio companies, budgets, 2020 plans, forecasts, et cetera. And for all of those, there was definitely a line of thinking of, okay, is there a way to get this to break even? If you need to, what does that look like? How much capital does it take to get there? So I definitely think that'll be the case here, because it's hard to know what exactly that Series A climate is going to look like 6 to 9 months from now, just in terms of what the appetite will be, and also how much capital is going to be in the market, you know, after these funds are deployed, because funds are going to see a lag in their own fundraising too. So it's definitely an area of focus to kind of go back to fundamentals and think about survival mode a little bit more.
Anybody else? So, Zach, did you have a question?
Hear me?
Yep.
Good. Audio's working now, finally. Sorry about that. I think we all know Zoom pretty well by now. Sorry, good to meet you, Geri. Quick question. I'm curious, you know, if there's any parts of the B2B software kind of environment that you guys are looking at in particular, and especially in this environment right now.
The question is if there's any sectors in B2B
specific parts of that, yeah, exactly.
Yeah. I mean, there's the obvious ones around healthcare and care delivery. So the investment that we just closed is actually in that space. It'll be announced publicly on Monday, but it is sort of in, you know, it's a B2B to C investment in healthcare care delivery. So everything from telemedicine programs to remote patient monitoring and all that. I think the other area that's fairly obvious is anything in remote tools, collaboration, you know, think Zoom and all of its analogous use cases. Within that, or beyond that, I should say, it really varies sector by sector. So I'll tell you the things that concern us for a lot of B2B companies right now, especially for anyone selling into a large enterprise. So whether it's large insurance companies, large financial institutions, whatever it might be, there's a serious concern that everyone's workforces are flipped upside down and that their decision-making will slow because a lot of these companies just aren't set up for remote decision-making or remote work of any sort. So there's a concern in a lot of those sectors of, is this a high enough pain point for anyone to really move forward with this now, and why now? You know, I think every pitch that we're seeing is addressing what is the impact of COVID, what is the opportunity that's presented by COVID, and then how does this become a sustained, you know, tailwind moving forward. I think it's hard to do sort of a complete, you know, COVID-dependent solution or pivot now, because then there's concerns that you lose that momentum once things go back to whatever the new normal is. But at the same time, you can't ignore it. So I think for any industry, no matter what it is, everyone has to be super specific to what is the exact pain point that companies have now, and why is this going to be a priority for them regardless of everything else that's going on? And for what it's worth, that's always a diligence question, right? Why is this a high enough priority? But now that bar has just been raised higher. Yeah, no, of course, that makes sense. And at least, you know, the trend towards, you know, remote collaboration, although COVID has obviously increased that a lot, obviously that trend was there before. So hopefully, as you're looking at those companies that are operating that space, they'll have a, you know, a decent rationale as to why that'll continue even after the COVID age. Yeah, absolutely. And I think we also kind of look at it based on the business functionality too. So, we're trying to figure out, for example, what's happening with every company's marketing budget over the next, couple months. What is the short-term, mid-term, long-term impact? Is there more of a focus now on operations and cost savings? What are just going to be the priorities of any given sector or industry on a longer term horizon, given the short term, shake up in things?
Yeah, exactly. Yeah, I mean, is there any kind of, bets that Laconia is taking on where it's seeing the COVID trend in terms of, immediate rebound versus, longer term impact? Is it making any kind of, forecast in terms of how it impacts its investment strategy right now?
There's no major change to our investment strategy. I guess we've always skewed a little bit more focused on business fundamentals and I guess a little more conservative and risk averse than the typical seed stage VC, just because of our high concentration model. So I feel like we were still kind of closer to the what if there's a recession style of investing than not to start with. So not a huge difference from us. It's really the biggest change is we're taking a much more sober look at everyone's sales cycle and go-to-market efforts, because that's, I think, the biggest thing for us, especially in the B2B space. When you depending on who you're selling to, you already have a 3 to 9 month sales process on average. If you make that much longer, you probably can't make it without raising more and more money, and that's really the challenge. So there's definitely been companies that we've looked at that had we met with them in January, perhaps the thinking would have been different because the expectations for that growth trajectory would have been different. But given where things are stalling now, for many of them, it's hard to see, why now is the right time. And candidly, for many of them, it's hard to see whether this is even still going to be a priority for their organizations, for the target customers when this is all over. So it's just a different set of macro questions and constraints. But the focus on business fundamentals remains the same, right? Do you have a highly differentiated product? Do you have, a scalable way to acquire customers? Is this something that's a growing market? And is there a way for you to potentially gain meaningful market share, whatever that might mean for your given industry, in a way that enables you to build this up to be a company that can do, as a rule of thumb, 100 million in annual revenue within 5 to 7 years? Those questions remain the same. It's just the answers, depending on what you're building and what industry you're in, are very different.
Yeah, that's helpful. I appreciate it.
Next question, and I know that we have somebody who got here later. Bobby, I know you're muted. Did you want to introduce yourself? Bobby? Maybe her audio's off. Anyway, does anybody else have a question?
I'll go. I think for me, the question is, how do you know when it's time to pitch? Because that's not something I had ever thought of really before, because there's so many avenues as far as social media, but it remains, now that I've done it once, it remains small even when it's at maximum. And like particularly with a business that has potential for international, obviously ad spend is like a really big area for growth that I don't have on my own. But then when do you know when it's time?
Yeah. My sort of snarky response was hopefully not right now. But it's a combination of a couple of things, right? To start, the first question I always have for founders is, why do you even need to raise money? So as a starting place, if you don't need the money to grow, I wouldn't raise it. I think there has to be a clear use case for why capital is the gating factor to your growth. I think ad spend is a fairly straightforward example of that, right? If I spend X, I get Y, and therefore, that's what we're focused on. But you'd be surprised how many times founders are like, I have this problem, and therefore I'm raising money. And I'm like, money doesn't solve that problem. that is a different type of problem. So that's the first thing, right? Is money the gating factor to your growth? And then it's a question of, how much evidence do you have that what you're doing works and will continue to work the way it has to date? So that's kind of the flip side of the ad spend thing, which is you don't necessarily know that your ads will continue to perform the way they have in the past. And you don't necessarily know that that is what will get you to sort of a sustainable, level of market penetration and growth trajectory. So I think there have to be other proof points as well in terms of validation you've gotten from the market in terms of why you know that you have, what are the beginnings of product market fit, right? That there's sort of a demonstrated and repeatable demand for the product that you're selling. And of course, this is different from stage to stage, right? So if you're raising a pre-seed or an angel round, that bar is very different, right? In that case, people are betting on your reputation, your ability to execute. They're really investing in you as a person and your competence. So the bar there is lower for what that market traction needs to look like. But if you're asking about raising capital from institutional investors, right, typical venture capital firms, whether they're focused on seed or Series A, there has to be some sort of early trend line into repeatability of what you're working on. And again, for different investors, it depends on their risk tolerance and what they look for. But I think the key things to have are some sort of repeatable growth, some identification of what the drivers are of that growth and what those levers are, and some insight into whatever you're tracking as retention or usage, right? So knowing that whoever's using it is coming back, so you can kind of get a sense of the strength of that value proposition in the market. So it's unfortunately not a super cut and dry answer, but I think there has to be a use case for why you need capital and why now is the right time based on the company's trajectory. And the other thing to think about is, what milestones does this get you to? So often we'll hear, I'm raising $1 million for 18 months of runway. And that doesn't tell us enough about what your plan is and where that company is going, right? Is it, I'm raising $1 million so that within 18 months, I hit 3 million in ARR, X customers, and, nominal break even, at which point I can potentially raise additional capital based on all these things I've heard in the market from Series A investors, right? It's a very different way to frame it than 18 months runway. Because at the end of the day, every investor is going to be looking at, why should I invest here and now, given the opportunity cost of investing somewhere else? What is that trajectory going to look like? And with what degree of confidence can I believe in the assumptions that are being set forth?
Mm-hmm. Thank you. That's super helpful.
Anyone else? Don't be shy.
Yeah, I have a question. To what extent are you seeing a dampening effect on investments by LPs and angels right now? We just launched an equity crowdfunding campaign on Republic, and they're saying that overall things are holding up reasonably well there. But I'm just wondering kind of what your sense is, because there's a lot of flight to cash. There's a lot of folks that are appropriately, I think, being very conservative. And I'm just wondering how much the venture community is experiencing that at this point.
Yeah, from what we're hearing, and this is obviously anecdotal just from conversations we're having and conversations who other investors we know are having, it seems like family offices have, for the most part, put pretty much all of their private investing, at least in terms of investing into funds, on hold for the time being. Institutional investors, to the extent to any of you are kind of familiar with that landscape, you have endowments, pension funds, foundations investing as limited partners into funds. They invest in venture as part of a broader portfolio. And as you can imagine, the public side of that portfolio is kind of underwater right now. Or at least, it severely was a few weeks ago. At this point, there's been some recovery, thankfully, but there's still a lot of uncertainty there. And you know, these institutions have a constraint in terms of what percentage of their total assets under management they want to invest in privates and specifically in venture. So as your total AUM shrinks, when the value of everything falls, you end up with what's called the denominator problem. And they're like, oh crap, like our 10% venture allocation is now 18%. So what that means is, you know, anyone who is hoping to be a new manager added to their portfolio is, you know, kind of waiting this one out. Yeah. So that has, you know, pretty serious implications for, you know, for funds like ours that are, you know, potentially raising new funds from these institutions. So on the institutional side, for sure, what we're hearing is everyone is saying we're not adding new emerging manager relations right now. This may or may not change by the end of the year, but realistically, we're probably not adding any new names until 2021. And, you know, the family offices and the individuals have more flexibility because they don't have sort of a, you know, a corporate mandate. It's whatever they want, but there's definitely been more caution there too. You know, on the angel side, I think for anyone who's raising angel capital, I think it's still case by case. There's definitely a consensus that if you have the liquidity and the capital, now is a great time to invest. So the extent to which you can find those people, I definitely think there will still be appetite. It's just a question of finding who actually has liquidity now without having to like sell things at a loss.
Right.
But yeah, I think there's a consensus that it's a good time to invest if you have the capital to do so.
Cool. All right. Well, that's great.
You know, Fran, I was wondering if you wanted to chime in on this one.
Yeah,
since you
Fran, what are you hearing?
Yeah, you're an angel
Good
investor.
call, Bonnie.
Yeah, she's part of 37 Angels, by the way.
Fran, you're on mute. Fran, you're on mute. Okay.
Oh, Fran, you're on mute.
Yeah.
Oh, there we go.
I'm never mute in my own head, so I have to look to see where I am. You know, that's an interesting proposition that you described. I was on a call recently with a couple of venture capital Series A investors, and their thought is things that were in the pipeline would proceed. I mean, if they were going to proceed, they would proceed, but nobody was right now interested in hearing things where they couldn't meet people, which, you know, particularly in this industry, I found very interesting that, you know, Zoom didn't suffice as that meeting ground. And I don't know whether, you know, in the first 2000 decline in the internet space, I was at a PwC, they call it Shaking the Money Tree or Money Tree, and it was all these venture guys from PwC and other funds. And they said that in this market that was so terrible at the time, the question was asked in the room, are you investing? And they said, the sad truth is that our LPs want us to invest and want us to risk and want us to make some sort of investment, but we ourselves are scared to do it. And we're making money without doing it with the money we have, as you all know. And so we're less likely to risk when the market is bad, which, you know, everybody can assume to be true, but I heard it very interesting. I thought it was very interesting to hear it out loud. And as far as angel investors, I think it depends upon how hard your portfolio was hit, you know, and, you know, what kind of risk you can take and where you are in your career and all those normal things. So I don't think there's a standard, but whoever just said that investing now is a wonderful thing if you can do it, makes a great deal of sense. I just want to go back to the future so I know what to invest in.
Yeah, and it's interesting, the point about investing in people remotely versus having to meet them in person. I think that's one of the areas where there's a pretty serious divide based on stage. So, you know, pre-seed and seed stage investors, I think will have an easier time getting there because for the most part, they're writing smaller checks. They're writing smaller checks relative to their total portfolio size. So they can kind of get over that hump. But if you're a Series A or B investor writing a $15, $20, $30 million check that is 10% of your portfolio, I think that bar becomes a lot higher. And those funds, you know, again, the later stage you move, the more risk averse they are, and the less you want to make a massive mistake, no matter how sort of risk-taking venture is supposed to be. So I think that, Fran, what you said is consistent with what I'm hearing too, that most funds that are Series A and later are holding out for the next 6 months. I think that's right. And I think that's part of the concern for the seed stage ecosystem too, which is, well, 6 months from now, are we still going to be kind of in this like weird social distancing stage? Because if so, you know, all these milestones that these companies have set for raising a Series A in 6 months are going to be irrelevant if the Series A investors still aren't ready to write checks.
Yeah, and somebody also made the point that if you don't, I think it was you, Geri, if you don't need to borrow money or to raise money, not to do it. And I don't know if you guys know Rafat Ali, who's the CEO of Skiff.
Yep.
But he wrote this wonderful piece several years ago now about when he was trying to raise the next step, and he looked around at his employees, and he suddenly remembered being an entrepreneur and realized cutting the people in half, you know, or whatever the number was, and getting back to their roots and not taking that money and retooling their business appropriately made him much happier. And he, if you want to look it up, he wrote a whole article about it that I think is well worth reading for people in different stages of raising capital.
How can we find that article? Where can we find it?
I will Google it now and see if I can find it.
Okay, great. Rafat Ali is the founder of Skiff. And before that, he was actually the founding editor at Silicon Alley Reporter way back when, and then did paid content. Remember that, Fran? Anyway, next question.
I actually have another question. It strikes me, it has always struck me actually, that the angel and seed ecosystem is really kind of balkanized into these little regions and, you know, social networks that are very local. And it's pretty inefficient that way. That is, you would think there would be like a more of a national market for investments and investors. And I'm wondering if the whole COVID experience and the increased use of Zoom and other forms of video chat are gonna kind of democratize and make that market more efficient. I'm sort of hoping so, because it really has struck me like, you know, these groups that, like, you know, just invest within 50 miles of them, and, you know, what's the point of that if you can't meet up with people anyway? So what are your thoughts on that?
Yeah, I am similarly hopeful. You know, I think one of the challenges traditionally with seed stage investing is that you can't have costs of doing business or doing deals that are above a certain threshold if you're writing a check that's below 500K, right? Like you can't spend, you know, 20K on airfare and board meetings and all of that. It just doesn't make sense. So I think that's been a logistical constraint for a lot of these funds, especially when, you know, a lot of seed funds are small. They're sub $50 million. They're often sub $20 million. So you don't even really have the management fee income to do that, right? Like you literally don't have the money to spend on that kind of stuff. So I think that logistical constraint in large part has been removed now. I think the piece of it, there's two pieces that haven't been removed. One of them is if you have some sort of thesis mandate or constraint that, you know, you raised money around a particular thesis, right? So our fund is kind of in that bucket, right? We are predominantly focused on New York, Boston, Philly, and DC. We have some flexibility in our deal docs to do, you know, a deal or two outside that. There's a certain fund allocation that's, you know, discretionary. We can kind of do with it, you know, things that are a little bit outside that mandate. But for the most part, we have that mandate. So COVID or not, we can't start investing, you know, in Ireland. We just can't do it. So there's that constraint. And then the other constraint that exists is bandwidth. So a lot of the ways that investors make decisions and get comfortable with things is based on talking to a lot of people who they know and doing reference calls and all that. And so if you already have some sort of focus, it's much easier for you to do your diligence in a region that you're already familiar with and have a strong network in, right? It's much easier for me to do reference calls for a founder who's in New York, who raised their pre-seed from a pre-seed fund we know, and who did all these things, just because there's more familiarity there versus an entirely new ecosystem where, you know, it's just harder to get over that trust barrier because you have fewer common points to start from.
Yeah.
So I think those are kind of the two things that are going to be challenging for people to overcome. But I do agree that hopefully the bar is lower now. And one of the things that really grinds my gears about the venture ecosystem generally is the reliance on warm introductions and networks and people you personally know, because I think that's just wildly inefficient, not to mention like wildly discriminatory just based on how people's personal networks operate and who typically controls capital.
Yep.
You know, it's definitely a straight line to the very, you know, inequitable outcomes that we have in the venture ecosystem in terms of who gets funded and why. Yep. And so, you know, it's funny, I think all the investors who, you know, a couple months ago were sort of, you know, too busy and too good to answer cold emails or take inbound from entrepreneurs, you know what? They're all sitting in front of their screens right now, just like we are. And if they want deal flow, they're going to have to find it somewhere other than, you know, their buddies, you know, country club. Like that's done for the time being. So I think in some ways this has been a, you know, a democratizing factor in that we're all just stuck behind our screens, and you know, if you want to meet anyone, everybody has the same mechanism now to do that. So
I agree.
I'm getting a definitely, you know, a reasonable amount of satisfaction and optimism about that.
Cool. I was just going to mention that Lightspeed just launched a platform so that anybody can now pitch to them. You saw that, right?
Oh, it's incredible. If only the internet allowed you to do that before they launched this platform.
Right.
Why couldn't they take pictures before?
I don't.
Well, Lightspeed is pretty snooty. I know a few people from Lightspeed, and they're like up there in the, you know, the stratosphere.
They really are. They have such attitude.
I had lunch with a partner at Lightspeed, and she said, "Well, you know, I can't really bring unicorns to partner lunches anymore, because to get anyone excited, it has to be a decacorn." I know. Good luck with that. That's
man. Yeah, so those people are going to see a haircut in valuations.
Let's hope so.
That's where it's going to be.
Yeah.
I know one of the
partners. No, but it's wild. It's wild. Yeah, but you know, it still doesn't help you overcome the trust factor. That's the challenging part, right? So like we look at all our cold inbound, we always have. I look at every email I get. I respond to probably 95% of them. We've invested in one deal that came in cold. We've done serious diligence on a handful of others, but it's still, it's harder. It's definitely harder. And all else equal, I think that's the piece that'll be harder for entrepreneurs to make up, right? Those sort of connections that you can make that will have someone not just make an introduction for you, but make an endorsement for you. Because those are the things that carry weight, right? We get, you know, as investors, we receive things all the time from other investors that are like, did you see this? I saw this, but there's no sort of strong recommendation attached to it. Those don't mean as much. But if someone is like, hey, you have to meet this person. I've worked with them before. They're phenomenal. That's kind of, no matter what anyone says, like that will always take priority, at least in terms of mind share and mental bandwidth over anything else.
I have a question. I mean, just sort of on the topic that you were just talking about, is it, I mean, in terms of, it seems like a weird time for, you know, as a founder to be trying to network and sort of connect with potential investors. I mean, we're sort of, you know, pre-seed. Should we be sort of, we've kind of thought, well, people are busy and maybe they've got health issues and things like that. So we're going to refrain from bothering people at the moment. But so I guess the question is, should we start bothering people and doing that sort of outreach now? Is that going to be interpreted badly or as being sort of annoying at this stage, given everything that's going on?
No, I don't think it'll be seen as annoying. You know, I think a month ago when, you know, New York City shut down all non-essential workers and all that, there was definitely a bit of, you know, it was more of an internal focus. How do we adjust our internal operations and how do we help our portfolio companies? I think that wave for the most part is over now and everyone is kind of in this new normal for the time being. So I think now is not a terrible time for most companies. You know, of course, you want to be sensitive to any personal issues that anyone might be going through. So I wouldn't put anyone on like an 8-step drip campaign with like the, hey, didn't, you know, did you see my last email? Like, just tell me to go away. If you don't, none of that, obviously. But I think, thoughtful outreach to people in a targeted way, your odds are probably better now than ever before, because everyone is stuck to their screens, and candidly, they don't have that much to do other than sort of the, immediate business stuff. So I think it's a great time to sort of really take the time to build a list of 20, 30 funds that for some reason based on your research, you think are a good fit for what you're working on, whether it's complementary investments that they've made, maybe it's their stage focus, maybe there's some other commonality, and just write really good, not too long, concise emails that are very specific to the person you're writing to, with some sort of, call to action on either getting feedback on what you're working on or discussing a certain topic or introducing the company, whatever it might be. I would guess that the response rate to those will be pretty good now. Because again, people are trying to keep their deal flow going, even if they're not investing right now. If they have capital under management, they will want to invest it over the next year or so. And for the funds that are more relationship driven, it takes time to get to know people. And especially in this current digital environment, the more time you have to sort of build that foundation, the better. So yeah, let me know how it goes. If you reach out to 30 people and nobody gets back to you, I want to know who they are.
Okay, will do. Thanks, Geri. Appreciate that. That's helpful.
I was going to say, do you want to share your email address with everybody?
Yeah, my email address is geri@laconia.vc. It's on my Twitter. It's on my LinkedIn. Okay. If you just Google my name, you'll probably find it. Yeah. Here, I'll put it in the chat just so everyone has it.
Hey, Andrew, this is Ham Hampton. I wanted to follow up on what Geri said about is it the right time or not? I think from the perspective of what I hear talking to founders like yourself or in the pre-revenue stage, sorry, it's a big mystery about, are you going to be able to get to scale based on the plan that you wrote before this happened? So to be intuitive, and to Geri's point, don't write an email that's not salient to why your proposition is different, and you've thought through this and you've negative engineered the outcome, and here's what we're doing, because that's going to pique somebody's interest. And what I do from a standpoint of go-to-market strategy, and I'm sure Geri probably looks at this, and so does Fran, is have you thought through what your customer acquisition process is? Do you need to calibrate that different? And if so, and you figured out a way to do it, maybe you're not going after enterprise, you're going after mid-market clients first because it's a shorter sales cycle. Okay, that impacts your cash flow and what you need to raise and how soon before you break even, and et cetera. So all these thoughtful processes that you've gone through and negative engineered your business. And, as Geri and Fran know, you got to know your numbers always, but you also need to have a plan, and it has to be articulated. So if you have snippets of the plan that you want to use to introduce yourself to people, I recommend that to my clients. I'm sure Geri and Fran have some input on that, but it's the story that you're telling about how are you going to deal in the environment that we're dealing with that's going to be compelling.
Yeah, definitely. Definitely. The one thing I'd add to that is you just want to make sure it doesn't sound like a fundamental pivot, assuming it's not a fundamental pivot, because then investors are going to want to see some proof points that the new plan is working, right? It can't be we did this to date and now we're doing that. They're going to be like, well, how do you know that that's going to work? So I think there has to be a good amount of nuance there in terms of how you're communicating the traction that you have, the momentum that you're seeing, and again, how that gets sustained post-COVID too.
And Geri, you might agree. I think that there's nothing sexier or more important than being honest and saying, in view of what's going on in the world, we've modified, or we've, retooled, or we've pivoted, or we've given serious consideration as to what's going on, and we still think that this is a viable solution.
Yep.
This is the elephant in the room. You need to address what's current and how that affects you, and nobody's interested in somebody that pivots on every piece of news. But it's important to state, I think, where we are today and how your plan fits into that, and address it before anybody has a thought in their head.
Yeah, definitely. I mean, even before COVID or outside of it, I typically like to see plans articulated as here's the short-term opportunity that we're going after, and here's how it's here's how it's part of this bigger vision, right? I find that two-step narrative really helpful, and seeing, okay, here's sort of the immediate focus, and then here's where the large opportunity is. I think that framework is the same now. It's just that the short-term part has to reflect the current reality of COVID effectively, right? And it's, here's what we're focused on now, given these constraints, and here's how it's part of the bigger vision, or here's how the bigger vision does not change, even given these circumstances.
Makes a lot of sense.
Oh, you're on mute, Andrew. Did you want to ask a question?
No, I just said that all makes a lot of sense. That's very helpful.
Cool.
I have a question, Geri. If you're looking for pre-seed with the idea to use that capital to build out the platform, what do you need to bring to investors to kind of prove your idea? Like, would you recommend a simple MVP of your idea with some users to kind of show use case? Or is there some other route you would take?
How much capital do you want to raise?
I'm not really sure. That's kind of what I'm asking, because I'm thinking, like, if I could just bootstrap something, that might be the better play. It's just like I need to kind of sort out my costs for how much I want to spend on creating like the initial product. Like right now I'm using a no-code tool, but it's obviously not enough to
right.
scale, right? So I don't know if that's enough to prove to someone that that's a viable like concept.
Right. So I'll share this again with sort of an East Coast ecosystem perspective. And if anyone has visibility into what, West Coast pre-seed and seed funds are doing, please chime in. My experience from, New York, Boston, et cetera, investors is there is very little appetite for pre-seed, pre-product, pre-launch solutions on an institutional level. There's a short list of maybe 5 to 10 funds that are investing at the pre-seed with any sort of consistency. Beyond that, it's all friends, family, and angels. That's it for rounds that are, I would say, below $1 million. Really below 500K, but even below $1 million, it's hard to put together an institutional VC round on the East Coast. West Coast might be different. There might be more capital focused on that stage. And for that, if you're pitching friends, family, and angels, for the most part, again, they're investing in you because they know you and trust you. So, that's sort of a kind of a different line of pitching for people who know you personally. For pre-seed investors and, professional angels who don't necessarily already have a pre-existing relationship with you, I think it's helpful to think about what are sort of the metrics or the proof points that you have regardless of the product. So is it number of signups? Is it a wait list? Is it engagement with this MVP? Is it, a complementary product or community that you've built that demonstrates the demand for the new thing that you're building? I think there has to be some sort of evidence of just market demand for this. And an MVP may or may not provide that depending on how your users interact with it. Obviously the more the better, but I think at the end of the day, for any of those rounds, they're going to be mostly focused on individuals. And in many cases, you're not going to have more than a deck, because if you don't have the capital to have built anything yet, there's not much that you have there, again, other than sort of early interest from users that you've accumulated in some way, and basically the plan of what you're going to build. If anyone else has kind of insight into other investor groups, or Fran, if you want to share some context from the angel perspective, that would be helpful too.
Nothing more than what I said. I think you captured everything.
Just to add to that question, if at that sort of stage you actually have an MVP and can do demos, how does that change the answer?
On the institutional side, not by much. I think there's certain levels of just traction that institutional investors are going to look for before they write a 400 or 500K check. And I think it also just depends, it correlates with round size. So if you are raising less than $1 million, I think there's still going to be limited appetite for the most part, just in terms of the way these funds are structured. But I guess it depends, you mentioned there's a product in market. I guess it depends how many people are using it. What does that look like? Is there a clear trend forming in terms of customer acquisition, repeatability, and retention? If there is, then it sounds like you're no longer in that pre-seed stage. You're more so in a true seed, which might open up that pool of capital to you a bit more.
Anybody have a question? I know we have some late arrivals if they want to introduce themselves. I know that Bobby's busy, but the other Bonnie Halper is not really me. It's an SOS reader. I don't know if you want to introduce yourself. I guess not. Okay. Any other questions or issues?
I have a question, a little bit of a selfish one, but so as I shared before, I was leading a startup for about 2 years, significant success, ended up leaving because of cap table issues that predated me. But I was working for equity. So in order to stay married, I need to bring in some income. So I guess my question is, I'm doing a fractional CTO role right now, and I do have a number of roles in the pipeline, which are interesting at different stages. But what are you seeing in your portfolio as far as hiring right now?
I think we have 3 companies right now that are actively hiring. The majority have put hiring on freeze for the next couple of weeks at least. We have a handful that are hiring, and they are mostly hiring on the product and engineering side.
Rachel is doing very well right now, right?
Yeah, they're doing well. They're hiring some product people. I think that's standard across most companies right now, unless you're in something that is, again, kind of healthcare, remote tools. Maybe then you have sort of sales and customer support growth as well. But for the most part, I think a lot of companies are putting a pause on that just because they're not sure what sales are going to look like, and they don't want to, bloat that team right now. So I would guess that engineering and tech, I think you're in a good place right now in terms of openings that way. I don't know how you structure sort of the fractional CTO work or the, any consulting work that you're doing, but I would guess that there's a reasonable amount of demand for that now, because companies are using this opportunity to further build out product while there's sort of a pause in the market. Yeah. And at the same time, they don't have unlimited resources to do so. So anything that is sort of a more cost-effective solution, I think can be helpful.
Okay, thanks. I appreciate that.
Mm-hmm.
Anybody else? So we usually stop around now for one-on-ones and networking. But well, this is a different climate, isn't it? And a different
climate.
Well,
yeah.
we can still do the private networking in the chat session if people
that's
want
true.
Feel free. There's some little dialogues going on.
There are also breakthrough rooms where you can split into a smaller room for a second and then come back as a big group.
I never did the smaller room. I know about them, but I've never done that.
Yeah, I'm not sure how it works.
I'm not sure how it works.
Matt? I don't know if it's something you have to set up in advance.
Maybe you do. We'll have to work. Are you still there, Mac? We'll have to work on that one.
Yeah, that would be a cool setup for future ones. You could set up like sort of like an office hours room if people have one-on-one questions that they don't want to ask in front of a group.
That's why we usually stop around now. But are you still doing your office hours, right?
We are. Yeah, we are. So we do office hours / mentor meetings every Tuesday from 1 to 3. There's open signups on our website. You can just book a slot, book half an hour on our calendars, and just ask any questions you might have. So we've been doing that for about 3 years now.
That's right. I'll put it back in the newsletter. I wasn't sure if you were still I should have just looked and I used to put them in every week.
Yeah, thanks for that.
Oh, so we'll have to figure out we're going to do another breakfast either next Thursday or, I don't know why I'm calling them a breakfast. I guess it's a breakfast meeting, right?
Breakfast. Sure.
So that I might even make them a little later so some of the West Coast people can join, although we do have some internationals here today. But I'll put the information in the newsletter, and Kettle Space will have them as well. Anything else? Any last questions? I wish we had the breakout rooms. And
I know, I'm looking it up
I'm
so
trying
hard.
to figure out how to do them, and Mac isn't here. I'm like,
we're testing with clients soon, so we'll let you know how it goes.
I
We'll figure it out.
I think, Bonnie, it might just be, let's try this, and if it's not that, it's going to be too complicated. You see at the top corner, you've got the 3 little dots. If you hover your mouse over.
Where's the 3 little dots? 3 little dots.
Wherever you find like how to mute people or chat people.
I don't see it.
You're the one who started the meeting, right? It's not someone else.
Oh, it was Mac who started the meeting.
Then you don't have that.
Right. Yeah, I know he was supposed to turn that over to me, but I think he's on another.
Yeah, that's what it is. You would have to be the host to have that.
Oh, okay.
Like ability.
Yeah, no, I just tried to ping him, but I think he's on another.
We didn't try.
No worries. Well, you all have my email. Bonnie, feel free to send it out to everyone as well in case people didn't grab it from the chat window. But if there's anything else I can be helpful with, or if you have more specific questions that you could just use a perspective on, more than happy to help. Feel free to reach out and hang in there.
Thanks for taking the time.
Thanks so much, Geri.
Thanks for having me. Great to meet you all. Enjoy the rest of your day.
That was great.
When
Stay safe.
it's all over, we will have you there in real life too.
Thank you. Thank you. Appreciate it. Take care, everyone. Bye.
You too. Everyone's welcome to stay until 10 if you want to, or hang out with each other, or leave if you need to.
Yeah, Bonnie, I got to jump, but we should definitely catch up soon. And great to hear you're doing well. Yeah.
Okay.
All right, Beth. Talk later.
Yeah.
Thanks.
I need to go too, Bonnie, but I want to reach out and catch up. So I'll send you an email and see if we can chat.
Oh, my email is just hello@Startup One Stop, and if you want to go and sign up for the newsletter, I put it into the chat. So thank you everybody for coming, and thank you Kettle Space for hosting us. And we'll have one either next Thursday or the following weekend. It'll be another early stage, in BC. Okay. All right. Thank you, everybody. Bye.